Last time we stopped off here, we talked about the beta for these selected stocks. What is the average beta for the market? 1, because we are comparing everything versus the market, so the market's going to move exactly the same as the market. If a stock has a beta less than 1, is that riskier or safer? Yeah, it's safer, and if it's got a beta greater than 1, then it's riskier than the market. So, what we're going to see when we put these things in a portfolio, unlike standard deviation, here we're actually going to be able to use the weighted average. The reason we couldn't use the weighted average on standard deviation is because we had two kinds of risk represented in standard deviation. We had the diversifiable risk and the undiversifiable risk. And when we put those things in the pot together, we could get rid of that diversifiable risk, or the unsystematic risk, but we were left with the systematic. And so that's why we couldn't simply do a weighted average of standard deviations. But beta represents pure systematic risk. Therefore, there is no reduction of beta when you throw it in the pool with other betas. As a result, it's so easy, comparatively, to figure out the beta for the portfolio versus the standard deviation. It's just a weighted average. It's just a weighted average. And so the same portfolio weights that we calculated previously, now all we have to do is take the portfolio weight on stock A and multiply it by the beta on stock A. And then we're going to do the same thing for all the stocks in our portfolio and then just add them together. And what's going to come out of that's going to be a weighted average, and that's going to give us the beta for the overall portfolio. Now remember, when we calculated the weights, we took the market value for the stock and divided it by the total market value of the portfolio, which is just adding the market value of all the stocks in the portfolio together to get us the weights. Okay, so any questions about this? This is about as simple as it gets. Way simpler than standard deviation. So now we're going to move on and talk about the security market line. We know that risk and reward have to go together. We know that beta represents systematic risk, which is the kind of risk that the market rewards. Therefore, there should be some sort of mathematical relationship between the beta of a stock and the expected return on the stock. And that relationship is given to us by the security market line. So let's start out here, and all we have to know to basically come up with an equation for a line are 2 points. Hopefully you guys remember some of this from algebra. We've got this formula, y is equal to mx plus b. Have you guys seen this before? In fact, if you're, let me guess, you probably saw it as y is equal to ax plus b.
Y is equal to mx plus c.
Oh, you got the m too? Did you get A's or M's? You got A's. Okay. So if you were educated, usually outside the U.S., they use A. But either way, what we've got here, this is the slope of the line. And that is what my grandfather would have said is rise over run. And that is the change in y divided by the change in x. And if we wanted to see what the change in these things are, we would say y2 minus y1 divided by x2 minus x1. That's going to give us the slope of the line. Okay, now, what's this other thing called, this b?
Intercept.
Yeah, it's the y-intercept. That is the value that y takes on when x is 0. So in order to find the equation of any line, all we have to have are 2 points. And we have 2 points on this line. The first one, we know that the risk-free asset has the return of the risk-free rate. That's going to be our y value. And it's got a beta of how much? Yeah, 0, because it's risk-free, right? And so we've got 0, risk-free rate, because that's x, y. Okay, now we know that the market has an overall beta of how much? 1. And we don't have this number here, but we're going to call it the expected return on the market. First thing I want to point out to you is that the return on the market, it's the expected return. Do we know it with certainty? No. Why isn't this expected? It's risk-free, right? We know it with certainty, and that's why we don't see an expected on that. Okay, so first thing I can do is come up with this slope. N is equal to, let's see, it's y2 minus, so y2 minus y1. Does that make sense? Divide by x2 minus x1. Okay, so what happens there on the bottom? Yeah, it's just 1, right? When you divide by 1, divide anything by 1, what do you get? You get that thing, right? And so we can just erase this. Now, this thing hopefully looks a little familiar to you. You remember we said that the risk premium of anything is just the expected return on that thing minus the risk-free rate. Okay, so this has a special name. It's the market risk premium. Because this is the expected return on the market minus risk-free rate. It's the market risk premium. Okay, now I want you to think about this. We're saying this is the slope of the security market line. And oftentimes, when I ask students on an exam, what is the slope of the security market line, what they will say is beta. Beta is not the slope of the security market line. Beta is the x-axis, right? Beta is x. And so whenever you're asked, what's the slope of the security market line, the answer is the market risk premium. By the way, do you think that's a multiple choice question on the exam? Yeah, probably so. Okay. Now, the other thing we need to know in order to be able to write this equation out is the y-intercept. Do we happen to know what y is when x is 0? 0? Oh, swing and a miss. What is y when x is 0?
Negative.
Second.
It's negative.
We're going to take another swing at this. Ms. Pomeroy, what is y when x is 0?
Risk-free?
Yes, it's the risk-free rate. Oh my goodness. Did you get, so let's talk about the way ordered pairs work in mathematics. X is first, then the y, right? And so if we say this is x, it's 0, then this must be the y-intercept. You guys are so disappointing me with your math skills.
I thought you meant an actual number, that's why I was so.
You thought what?
I thought you meant an actual number, like what it is.
Have we mentioned a number for it yet?
That's what I was confused.
Oh my goodness. Okay, so the reason we use variables is because the numbers aren't always the same, right? We use variables because the numbers change, but we can plug them into the equation and then we get the correct answer. Well, hopefully. Okay, so now we can go back and put this into our formula. Y is equal to mxb, mx plus b. So we're going to say that y is the expected return on the stock I. Could be IBM, could be GE, who knows. And that's going to be equal to the slope, which is the expected return on the market minus the risk-free rate, and that's multiplied by beta. And in this case, the beta of the stock is going to give us the expected return of the stock. And it doesn't even have to be a stock. We could actually have betas for bonds. We're going to find that out later. That's going to give us the expected return for that thing, but we have to then add the y-intercept. Okay. Have I lost anybody so far? Ms. Rafael, have I lost you?
somewhat following you.
She's somewhat following me. Okay, so let's cover once again what this line is. So on the vertical axis, we've got the expected return on the security. What this line is going to allow us to do is to figure out what should be the expected return on that security based on the risk or beta of the security. And so if we're out there looking and we're trying to figure out how much should this stock return, all we've got to know is the beta, the market risk premium, and the risk-free rate. Okay, now, yes?
So you're gonna give, like, for the questions, there will be actual numbers.
Well, yeah.
Okay, that's just what confuses me when we have all of these letters.
How many hours of algebra did you have to have before you came here?
A lot.
A lot! So don't tell me you haven't seen the letters.
I know, it just, in my brain, it's not connecting.
Oh, it's just so sad. We have totally crippled your entire generation with poor education. And you have my apologies. I wasn't personally involved, but probably some of my generation was. Okay. Now, let's talk about what we can do with this formula. We can do a little bit of rearranging here. What if I said the expected return on the stock, and I subtract the risk-free rate from both sides? Uh-oh, this is on making noise. Okay, so now what I've done is I've subtracted the risk-free rate from both sides. Remember our definition of risk premium? It's just the expected return on something minus the risk-free rate. Well, check this out. The risk premium on the stock is just equal to the market risk premium times the beta of the stock. I know they're better looking than me, but you need to look at me. Okay, so once again, the risk premium on the stock. How is it related to the market risk premium? All you got to do is multiply by beta sub I. And so a stock that is 3 times as risky will have 3 times the risk premium. A stock that's 3 times as risky will have 3 times the risk premium of the overall market. Now, I'm going to go ahead and put this into the format that you're likely to see it. So what we tend to do is to say the expected return on the stock is equal to, in fact, the risk-free rate plus beta sub I times the expected return on the market minus the risk-free rate. That's typically how we see this thing written. Okay. Now, remember, this thing is called the market risk premium. When you are reading the problems, you need to make sure that you know whether you've been given the expected return on the market or if you've been given the market risk premium. Because if you've been given the expected return on, if you've been given the expected return on the market, then you need to subtract out the risk-free rate before you multiply by beta. But if you've been given the market risk premium, you don't need to subtract out the risk-free rate. So reading is quite important. And I'm going to give you one of these two things. I'm either going to give you the market risk premium, or I'm going to give you the expected return on the market. You need to know which you've been given so you'll know what to do with it, right? If I give you the market risk premium, do you have to subtract out the risk-free rate? No. If I give you the expected return on the market, do you need to subtract out the risk-free rate? Yeah. Now, risk-free rate actually shows up twice in this formula. So even though you might not have to subtract it out here, I'll still give it to you because you're going to need it over here. Does that make sense? Okay. Now, one thing about this picture that I want you to know is not true. And that is that there are stocks with negative betas. There are stocks with negative betas. And we'll talk about some examples of that here in a little bit. But let's talk about the impact that expected return, or the beta has an expected return. What if we were looking at a risk-free asset? What would the beta be of a risk-free asset? 0. If I take 0 times anything, what do I get? 0. And so the expected return on the risk-free asset would be the risk-free rate. Perfect right there. Now, let's ask what would be the expected return on the market? What's the beta for the market? 1. And so we're going to put a 1 right here. And when I do that, what I end up with is risk-free rate plus the expected return on the market minus the risk-free rate. What happens to the risk-free rates?
Cancel.
Yeah, they cancel each other out. And so that would give us that the expected return on the market is the expected return on the market. So that makes perfect sense. Now let's talk about what happens with a negative beta. By the way, let's talk about what kind of stocks give you a negative beta. Remember that beta, typically, what we're looking at is what's going on in the economy. And so those systematic risks are driving your expected return on the market. They're driving the return on the market. And then we're looking at the stock versus that expected return on the market. So what we're really looking at is, we could take this all the way back to the state of the economy. So typically stocks are up in good times and down in bad, right? Okay, so in good times, the higher the beta, the better. Does that make sense? In good times, the higher the beta, the better. Let's talk about what happens with a negative beta stock. If I end up putting a negative here, what's going to happen is that the return on the stock is going to end up being less than the risk-free rate. Let me say that one more time. If I put a negative in for beta here, my return on that stock is going to be, my expected return is going to be less than the risk-free rate. And I can prove it to you. If I put a 0 in here, then the return is exactly the risk-free rate. If I put something negative in here, this thing's got to be negative too. Now, why in the world would I put up with a negative expected return on the stock? And it's the answer is, it's not a matter of how much this thing is expected to pay, but when it pays. So, good times, you've got a good job, you're making a lot of money, the market's up, and your stocks are doing well, but you're not really, you don't feel it so deeply because, after all, you've already got a good job with high pay and good bonuses and all that. But what about when times are hard? What about when times are hard? The economy's in the toilet, you've lost your job, your dogs ran off, your pickup truck's broke down. You're in the dumps, right? There's only one bright spot in your entire life, and that is these negative beta stocks. Because when the market's down, what are negative beta stocks doing? Oh, come on. If the market's down, and so that we got a negative return on the market, we got a negative beta. Negative times negative is positive, right? And so these negative beta stocks pay off in bad times. That's why we put up with their bad behavior in good times, because of what they do in bad times. And you say, well, wait a minute. Would it be more important for something to pay off in good times or bad times? And now we're going to talk about something called the diminishing marginal utility of consumption. You don't have to write that down. Diminishing marginal utility of consumption. Let me demonstrate it to you. This spring break, you decide to go on a hike, and you go down to the Mark Twain State Forest, I think is what it's called. And you go out there and you're enjoying the nature, and you're out there so long that your phone battery dies. And so now you have no contact with the outside world, you don't have GPS to get back to your car, and you feel like a real moron. So what do? Well, you know you're supposed to just like stay put, right? Did you guys know that? If you get lost, stay put. Hopefully someone cares enough about you that they're looking for you. But if you keep moving around, it's hard to find you. Okay, so you're out there, you're smart, you're staying put. But then you start to get hungry. And you try to eat some tree bark, but it's kind of hard on your gums. You try to eat some grass, but it does not taste like arugula. You know, there are lots of nasty things you could try to eat, but so the first day goes by, nobody comes for you. The second day goes by, nobody comes for you. The third day goes by and nobody comes for you. And you say, you know what, forget it. You're like, I'm just gonna start walking. And so you start walking in what you think is a straight line, and then eventually you come to a clearing. Can you see it in your head? You come to a clearing. Sunshine on your face, you can feel it, you know things are gonna get better. And there I am. There I am, and I have a hot dog. And this hot dog is whatever you want it to be. It could be vegan, it could be kosher, it could be halal, it could be ballpark frank, whatever you want, whatever makes you happy, right? Whoop! I've got this magic hot dog. How much are you going to pay me for that hot dog? Keep in mind, you haven't eaten in 3 days. How much are you going to pay me for that hot dog? 10? Do I hear anything more than 10? Oh man, usually someone says, everything I've got, right? And then I say, no, I'm only going to charge you Disney prices, $20 for a hot dog, right? Okay, so you go to Disney World, hot dogs are just out the roof. Okay, so I'm going to take this, I'm going to sell you this hot dog for $20. And you're going to lick your fingers and say, oh, that hot dog was so good. Now, I say, whoop, I've got another hot dog. Ms. Pomeroy, how much are you going to give me for the second hot dog?
15.
15! Why not as much?
Hunger, already satisfied.
Yeah, we've already satisfied some hunger, right? You're no longer starving to death, right? Now you're just merely hungry. And so you pay me 15 for the second hot dog. And you're going, and I say, whoop! And I've got a third magic hot dog here. How much are you going to pay me? 5. Okay, well, he skipped straight over 10. My point to you is this. When you add additional consumption, more consumption doesn't bring as much pleasure. So I'll give you an example. When I first got a job out of college, it was 1994, my salary was $37,200. And most money that I'd ever, yeah! By the way, that was real money back then. I was an engineer. Okay, so $37,200. I'm like, yeah! And I thought, wow, if $37,200 makes me feel this good, undoubtedly $75,000 will make me feel twice as good. You think that happened? No. No. And it's because that first $37,200 satisfied my need to become middle class, right? With air conditioning and flush toilets, all the niceties that come with that. But getting from 37.2 up to 75, do you think that bought me that much more reduction of pain and suffering? No. And in fact, after a point, this whole money thing, of course, we know that the marginal utility of consumption is always positive, but it gets to the point where getting more and more money really doesn't do that much for you. So it's my freshman year of college, hanging out with my buddy Derek. His dad comes up to visit from Houston. He's a big deal civil engineer in Houston. And we were complaining about the price of textbooks. And we were complaining about a textbook costing $100. Doesn't that sound humorous today? Back then, that was big money, right? $100. And my buddy Derek's dad, Earl, laughed. He says, $100? He says, I piss $100 up against the wall. Now, what does he mean? $100 doesn't mean that much to him because he was making so much money being a big deal civil engineer down in Houston. Now, I am a college kid. I am making somewhere between jack and squat, right? $100 means a lot to me. And so my response to Earl was, piss my way, right? If you're going to piss $100 up against the wall, piss my way. I'll gladly catch that $100. Okay, does that make sense? It's the difference in the marginal utility of consumption. It was great for me. It was huge for me because I didn't have anything. It wasn't that huge for him because he had a lot. Okay, now, getting back to this, these negative beta stocks pay off for you when you're hungry, when you've been wandering in the woods for 3 days and you haven't had a hot dog. Now, let's discuss what kinds of stocks might have negative betas. And one version of your textbook says that negative betas aren't possible. That's total crap. As soon as I read that, I thought, that's stupid. And I looked back at the previous version of the textbook, and they actually gave examples of negative beta stocks. So here we go, negative beta stocks. I went out to my TD Ameritrade account, and I used the stock screener, beta less than 0. And primarily what I found were gold mining stocks. Let's talk about the gold mining industry. What are they producing? This is a simple question. Gold, right? And what price do you think they receive for their product? Yeah, the market price for gold, which anybody can look up online, right? Now, let's think about their costs. Their costs are fairly set, right? Their costs are not going to fluctuate that much based on gold prices. But their revenue is totally dependent on gold prices. And so when gold prices go up, the revenue goes up, but the costs don't come up with it. And so the profits just go crazy. And when gold prices are down, the revenue is down, costs don't go down at the same rate, and so the profit just goes straight in the toilet. Okay, now let's talk about, remember we said that what's going on over here in the economy is what's affecting this from the very beginning. It's the instigating event, the initiating event. If we've got crappy economic times, do people buy gold or sell it?
They buy.
They buy it. It's the uncertainty, right? I don't know what they're going to do with the dollar. The dollar might go to hell tomorrow, but gold has value, right? And so if I've got times of economic uncertainty, depressions, recessions, wars, contagions, we end up with gold prices going up. And so we have a bad economy leading to lower market returns, but at the same time higher gold prices, so the profits of gold mining companies are higher. What do you think happens to the stock prices of gold mining companies? Yeah, they go up. And so then, so far we can see there's this negative beta relationship here. The other thing is what happens when times get good. Do people hold on to the gold?
They sell it.
Yeah, they sell it. And what does that do to the gold price? It goes down. And what does that do to the profits of the gold mining industry? They go down. And what happens to their stock price? They go down. And so you've got this inverse relationship between these two. That's why these things are negative beta. Yes?
When you say the expected return on stock is going to be less than the risk-free rate, that's only in good times.
So the expected return, remember, is our scientific wild-ass guess. Do we know if we're going to have a depression next year? No. Do we know if we're going to have another pandemic? No. And so that's just our very best guess. And so our very best guess for these stocks is that on average they're going to return less than the risk-free rate. But in the weird chance that we have a recession, depression, then we know those things are going to be positive. That's a good question. Okay, now let's talk about why people get out of gold and into stocks when times are good. Does gold create wealth? If I take two little gold bars and I put them in the safe together and I lock them in there and I walk away and 9 months later I come back and open up the safe, are there going to be a bunch of little gold bars around? No, they're not creating anything. And in fact, it's worse than that because they're actually destroying wealth because there are storage costs to gold. And let me explain why there are storage costs to gold. If you personally owned a gold bar, could you leave it on your front porch? No, what would happen? Someone would steal it. Could you leave it on your coffee table? Someone's going to break your window and steal it, right? So basically, you have to spend money in order to keep people from stealing your gold. The way most of us do that is that we pay storage fees for the gold. And so basically, a company will store the gold and they'll hire a couple of guys with shotguns to keep the thieves away. Now, does that guarantee that you get... No, I was talking to a colleague of mine. I'm like, you know, if you and I were the guys with the shotguns and the crap hit the fan, what would we do? He's like, you take the gold, right? Okay. So gold, actually, you don't want to be sitting on it in good economic times because it not only does it not produce wealth, it actually consumes wealth for storage fees. And so what you want to do is sell the gold, which drives that price down, and move into stocks. What does that do to stock prices? Yeah, when everybody jumps into stocks, the price starts going up. Does that make sense? Okay. Now let's take a look. Actually, you know what? I'm going to skip this. If you want to know how to do linear regression to find beta, you can watch. I've got videos on it on my YouTube channel and in this. And if you want to help with that, come by my office. Students always ask me, why did you bother to go through that? Because there's no way you can test over it because you won't let us use Excel in an exam, right? And we're running a little behind, so I'm just going to skip that. Once again, if you want to see it, of course, there are videos out there of me doing that. Now we're on to chapter 5. We're going to use that first set of slides called Bonds and Bond Valuation. So the first question is, what is a bond? A bond is an interest-only loan. Now, the loans that you guys are used to are called amortizing loans, like car loans and mortgages. And with car loans and mortgages, each and every payment consists of both interest and, Ms. Minahan? Each and every payment for car loans and mortgage, when you make a payment, it consists of both interest and principal. And so you're actually paying down the principal over the life of the loan. That's not how bonds work. Bonds are an interest-only loan. They still make periodic payments, but those payments only amount to interest. They don't contain any principal. So when do you get the principal back? It's all at the end. So we got some vocabulary here. If you're a borrower, you issue the bond. You are called a bond issuer. That's how you borrow money. And so you're actually selling these bonds to the lender. And we call the lenders either bond buyers or bond holders. So the bond holders are the lenders, the bond issuers are the borrowers. And these borrowers are going to pay interest periodically over the life of the bond. And it's usually going to be either every 6 months or every year. And I'll always tell you which it is for our problems. And then they're going to pay that last interest payment and the entire amount of the principal at the end of the bond's life. So that's how a bond works. So let's talk about some bond vocabulary here. The first piece that I want you to know is the term coupon. The coupon is the interest payment that bonds make. The coupon is the interest payments that bonds make. And coupon is, I think it's French, and it means a little piece of paper cut off a bigger piece of paper, because it used to be when you would buy a bond, at the bottom would be all these coupons, and they would each have a date on them. And when that date came around, you could take your scissors and you could go chip, chip, and you could take the coupon down and you could receive your interest payment. In fact, a derisive term for trust fund babies used to be coupon clippers, because that's what they did for their money. They clip these coupons and take them down and get their money. Now, do we, probably 95+% of bonds these days are electronic. Are there any coupons really to clip in those cases? No. But we still call those interest payments coupons. So that's why we still do that. By the way, in finance, once we start calling something something, we hardly ever get past it, right? And so that's why we still call them coupons, even though there's no little pieces of paper involved. And then there is the face or par value. The face or par value is the amount of principal that's going to be paid to the lender at the end. The face or par value is the amount of principal that gets paid to the lender at the end. And it's perfectly fine for me to say face value or par value. They mean exactly the same. And then we have the coupon rate. The coupon rate is a rate that I can multiply by the face or par value to find the annual amount of coupon paid. The coupon rate can be multiplied by the face or par value to find the annual amount of coupon paid. Now remember, I told you that these coupons happen every 6 months or every year. If they are annual coupon payments, all I have to do is take the coupon rate times the face or par value, and that tells me how much the amount of those payments are. But if they're semi-annual or they happen twice a year, I have to cut that amount in half, because remember, the coupon rate times the face value gives us the annual amount of coupon paid, not the amount of the individual payments unless the payments are annual. And then we have maturity. Maturity is the amount of time left until we receive the face or par value. It's the amount of time left until we receive the face or par value. Long-term government bonds, United States, 30 years. And so on the day you buy that bond, the maturity is 30 years. What do you think it is 1 year later? 29, right? And 2 years later, it's 28 and so forth. Okay, then we have the price. Now this is where people start to freak out. They get price and par value, face value confused. Price fluctuates on a daily basis based on what's going on in the market. Price fluctuates on a daily basis based on what's going on in the market. And we'll talk about let's talk about yield and maturity also. People get yield and maturity confused with the coupon rate because they're both percentages. People get those confused. But the yield and maturity actually also changes every day based on what's going on in the market. And it all boils down to something that was at the very end of the chapter 4 slides, and that is that the price or value of anything is the present value of the future cash flows discounted at a rate appropriate to the risk. And so we're going to get to this in a minute, but basically what we're doing is we're taking all the payments that the bondholder is going to receive and we're adding together all the present values of them, and that is the value of that bond, and that is the price of the bond. Not to be confused with the face or par value. Okay, so present value is equal to future value divided by 1 plus r to the t. Now, I'm making this the simplest that I can. We've got a bond with the coupon rate is 0. We've got one payment hanging out there at the end. Let's discuss what happens here. Remember, the price is the present value. The price or value of anything is the present value of the future cash flow. So that future cash flow, that's the only thing we're going to be getting, and that is out here at the end. Let's call that the face value, because we said this particular bond has no coupons. Now, what is going on here? Well, we've got maturity here, and this R is actually related to the yield to maturity. And so what we can see is, as the yield to maturity goes up, what happens to the price of the bond? It goes down, right? And as the yield to maturity goes down, price goes up. And so I'm going to do this stupid little dance for you right now, so you will always remember this. I've got yield to maturity over here, and I've got price over here. As yield to maturity goes up, price goes down. As yield to maturity goes down, price goes up. It's a purely mechanical, mathematical relationship. It will always be true. And so, as people are bidding up and down the prices of these bonds during the day, the yield to maturity fluctuates. But, except in really weird circumstances, the face value of the bond does not change over its life. The face value of the bond does not change over its life. The coupon rate, except in weird circumstances, the coupon rate does not change over the life of the bond. The coupon rate doesn't change. And so face value, coupon rate are going to stay the same. Price, yield, and maturity are going to fluctuate. And of course, maturity is going to change over the life of the bond. As time passes, it's got less and less time left to maturity. Now, we can also talk about original issue maturity. And original issue maturity would be how many years did this thing have left on the date it was issued. And so I could be talking about a 30-year bond that might only have 20 years left. The maturity of that bond is in 20 years. The original issue maturity would be 30. Questions? Okay, so what's a bond worth? We've already touched on this a little bit. It's going to be the present value of the future cash flows discounted at a rate appropriate to the risk. And so what are the future cash flows we're receiving from the bond? Well, we've got those coupons, and then we've got the face value. And if you look at those coupons, they actually form an annuity. Does that make sense? An annuity is a set of identical payments that happens over a fixed amount of time. And that face value looks a whole lot like a lump sum. So this formula right here could be used to find the present value of that. And then all we have to do is add those two things together, the present value of that annuity of the coupons and the present value of that lump sum of the face value. And when we do that, we add them together, that gives us the bond price. You may also hear it called the market value of the bond, the market price of the bond, the price of the bond. As with everything else in finance, we have several different words for it. Okay, so get your calculator out if you have not already. Get your calculator out if you have not already. And we are going to do some bond pricing examples. So here's our first example. It's a bond with a face value of $1,000. What's another name for face value? Par value, very good. It's got a coupon rate of 6% and 10 years to maturity. Okay, so let's talk about one thing about face value before we go on. Unless I tell you otherwise, you are always to assume face value is 1,000. Unless I tell you otherwise, you are always to assume that face value is 1,000. Unless I tell you otherwise, you are to assume that face value is 1,000. And so if you're working one of these problems and you say, wait a minute, that bastard did not give me the face value. Immediately when you have that thought, I want you to think, aha! Face value is, Ms. Minahan, how much?
1,000.
Very good, 1,000. Okay, now we have the face value and we have the coupon rate. What can we do with those two numbers? What can we find? Yeah, we can find the annual amount of coupon paid. And so the annual amount of coupon paid here is going to be 6% times 1,000 or $60 per year. Now, they haven't told us the frequency yet. They will here in a minute. Oh, there it is. Interest is paid annually. So our annual payment is going to be $60, and that's going to be our coupon. Now, they tell us it's got 10 years to maturity, so that's our maturity. And then they say the market requires a 6% return on this bond. What do you think that's referring to? We already have the coupon rate. What's the other percentage? Yeah, the yield to maturity, right? So this is the market's required return is the yield to maturity. So keep that in mind. Now, another thing to know about the yield to maturity is it is an APR, annual percentage rate. And so an APR basically is the sub-period rate multiplied by the number of periods in the year. In this case, the APR and the EAR are the same. Does that make sense? But what if we were to have semi-annual coupons? Yeah, we'd have to divide by 2 because there would be 2 sub-periods in the year. In order to get that sub-period rate, we would have to divide that yield to maturity by 2. In this case, it's annual coupons, so we don't have to worry about that. And they ask, what is the market price of this bond? So what we're going to do is we are going to use our calculator, and we're going to do it in one step. This is pretty cool. We're going to do it in one step. We're going to find the present value of those payments, and we're also going to find the present value of the lump sum all at the same time. So get your calculator out, And the first thing we're going to do is say second FV. What does that do to your calculator? Yeah, it clears it out. Okay, now I'm going to say there are 10 years to maturity, so I'm going to put in a 10, and then which button do you think I'm going to hit? And, very good. And then the yield to maturity is 6. What should I do with that?
6i y.
Yeah, 6i over y. And then what should we put for PMT?
6% times.
Yeah, 6% times 1,000, which we said was how much? 60. PMT. And then we've got our face value hanging out there at the very end. We're going to call that future value. If you have trouble, you can remember FV is face value or future value. I want to point something out to you, though, on how to do quick math in your head to figure out the amount of a coupon. Okay, so we're going to take our coupon rate, 6%. We're going to divide that by 100% to turn it into a fraction. And then we're going to multiply by the face value of $1,000. This cancels. This cancels. What happens to these two zeros? Yeah, they go away. This goes away. So in the end, all I have to do, if it's a 6% coupon bond, it's going to pay 6 times 10 or 60 a year. So basically, as long as my face value is 1,000, in order to figure out the annual amount of coupon paid, all I have to do is take that coupon rate number and multiply by 10. So what would it be if the coupon rate were 9%? Well, 90, right? I mean, this is really easy. If the coupon rate's 12%, I'm going to ask Mr. Ali. The coupon rate is 12%. How much would my coupon be? Oh, no. What are you, so look on the board. All you got to do is multiply by 10.
Yeah.
What's 12 times 10?
Oh,
Oh, Mr. Ali.
I'm too sleepy right now.
Too sleepy, okay. Okay, well, I will call you this evening. We'll see if we can do better. I'm teasing, I don't have your number. Back to the story. So 12 times 10 is 120, right? So that's all you got to do. Mr. Ali, you may continue to use your calculator, but the rest of us, we can just multiply. Raise your hand if you can't multiply by 10 in your head. Your hand should be up, right? Yeah, we need to work on that, folks. Really need to work on that. Okay. So that's a shortcut that you can use. Now, if I'm going to find the present value of all of these cash flows, what should I do next? Compute? Yeah, compute PV. CBT, PV, and it gives me negative 1,000. I want to point a couple of things out here. First of all, that present value is negative. The reason the present value is negative is the sign convention of the TI-BA2+ calculator. Cash flows in opposite directions have opposite signs. So let's think about the way the cash flows with a bond. When I buy this thing up front for the price, that money is leaving my pocket. To me, that's a very negative thing, right? But then, when those coupons start coming back to me, that's a positive thing. And then at the very end, we get that future value, and that's also a positive thing. And so the coupons and the face value will always have the same sign, and the price or present value will always have the opposite sign. You might want to write that down. The signs need to match on the coupon and the future value, and they need to be opposite on the price. Now, I could have put in the coupons as negative and the face value as negative, and this present value would have come up as positive, right? The signs just have to be the same on coupons and future value, and the opposite on present value. So that's the first thing I want you to notice about this. The second thing I want you to notice is that this thing is selling exactly for its par value or face value. Do you think that always happens? No. In fact, it's a weird coincidence that hardly ever happens. And the reason it's happening is because the coupon rate is exactly the same as the yield to maturity. If the coupon rate is exactly the same as the yield to maturity, then we will have a bond that sells for its par or face value. In fact, we call this kind of bond a par bond. We call this kind of bond a par bond. A bond that sells for its par or face value is called a par bond. And remember earlier I said you could use par value and face value interchangeably. We talk about par bonds, but we do not talk about face bonds. No one says face bond, so don't do that. We use the term par bond. That means it's selling at par or face value. And the reason is that the required return, the yield to maturity of 6%, the coupons are exactly enough to satisfy the investor's required return. Let me say that one more time. The reason this thing sells for face value is because the coupons are exactly enough to satisfy the investor's required return. And therefore, they don't require any sort of capital gain between their price that they pay and that face value they receive at the end, because those coupons are exactly enough to fulfill their needs. Now, if you've ever looked at the markets and how they move, it's hardly ever going to be where these things perfectly match up. And so usually bonds are going to sell for more or less than this, but occasionally you'll see this, especially in finance questions. And what I'll do is I'll say something like this: a par bond with a yield to maturity of 6%, something, 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 what's the annual coupon payment?
6%.
Yeah, 6% times 1,000? What's 6 times 10?
60.
Very good. Okay, it's 60. Yeah.
So, since the present value is the same as the future value or face value, are you necessarily making any gain?
You're making all your money off the coupons. You're not demanding any gain on the, what we would call the capital gain. And so it's like buying a stock that only pays dividends, right? You're not going to get a capital gain out of that. You're just getting the dividends.
Okay.
And hey, money's money, right? So here's what the deal is. I know, based on the riskiness of this company, I know what percentage I need out of this bond. Now, when they first issue bonds, what they try to do is match the coupon rate to what they think that number's going to be. And so, just like for the first 3 seconds, these bonds tend to sell at par. And then, of course, the market starts to take over and things kind of fluctuate. We will get to what happens when it's not enough to satisfy. Okay, other questions? Do we ever call this thing a face bond? No. Here is our bond pricing example number 2. Bond with a face value of 1,000. I didn't even have to tell you that though. Has a coupon rate of 6%, 10 years to maturity. Interest is paid annually. So far, does everything sound exactly the same? Yeah. The difference here is the market requires a 7% return on this bond. So what's the market price of this bond? So keep in mind.
BMT is 70.
Are you sure? It says that the coupon rate's 6%. Right? You're confusing yield to maturity and the coupon rate. And so the basically interest rates have risen here. The yield to maturity has gone up. And so the only thing that's really going to change in our calculation is what we put in for I per Y. All those other numbers are still in your calculator. If you wanted to see, you could just type recall PMT, recall future value. It's all still there. So here's what I'm going to do. I'm going to say 7 I per Y. And so that's the only thing that changed. What would I do now to compute the price of the bond? Compute? What am I computing? PV, very good. And now we're looking at negative $929.76. Can someone explain to me why the present value is negative and the coupon and the future value are positive? Yeah, it's this cash flow in opposite direction, right? Sign convention. Okay, so the next thing I want you to notice is this is less than face value. This is less than face value. And so this bond, we say, is selling at a discount to par. This bond is selling at a discount to par. We could also say it's selling at a discount to the face value. And this type of bond we refer to as a discount bond. Now, why is this thing selling for a discount? Do you think it's like on sale? It's like, woo! It's like 7% off here, right? No. It turns out that this bond is just as fairly priced as the last bond we looked at. Because the situation here is that the coupons are not enough to satisfy investors' required return. So they're going to have to get it somewhere else. And the way they're going to get it is through this capital gain. The capital gain going from $929.76 all the way up to $1,000. That's going to be the other source of return on this bond. And when I put those two things together, that's going to bring my return up to that required 7%. So 6% of that's going to come from the coupons, and that extra 1% is coming from the rise of the price in the bond from $929.76 all the way up to $1,000 at the end. Questions? So that's a discount bond. Now let's go to the next one, and it's all the same except for we're looking at a 5% yield to maturity. Where do I put that in? 5? Oh, you did it again. I per Y, yeah. 5, I per Y. And then what do I compute? PV. This time, I want you to see that the bond is selling for more than its face value. This time, the bond is selling for more than its face value. We say it's selling at a premium to par. It's selling at a premium to par or premium to the face value. And the amount of that premium is, by the way, $77.22. And we refer to this kind of bond as a premium bond. Maybe you're familiar with premium brands. So we've got a Calvin Klein designer warm-up jacket right here. And he's also got an Under Armour hat on. These are premium brands. He probably paid more because they were... Did you pay more? Yeah, he did. Okay. So if you didn't, I wanted to know where you got. Okay, so back to this story. Does that mean a premium bond is a better bond than a discount bond? No, they're all priced fairly. And let's talk about why people would be willing to pay $1,077 for a bond that they're only going to get $1,000 back at the end. And the answer is that the coupons are more than enough to satisfy the investor's demanded return. The coupons are more than enough. Anytime that the coupon rate is greater than the yield to maturity, it's going to be a premium bond. Anytime that the coupon rate is greater than the yield to maturity, it's going to be a premium bond. Anytime that the coupon rate is less than the yield to maturity, it's going to be a discount bond. Anytime that the coupon rate is less than the yield to maturity, it's going to be a discount bond because in that case, the coupons are just not enough to satisfy the return. But in this case, because the coupon rate is greater than the yield to maturity, the coupons are more than enough. And so people are willing to bid up the price of this bond until the expected return on the bond is that yield to maturity. So they're going to bid it up, and so they're going to get a 6% return out of those coupons, and they're going to get a basically negative 1% return out of that capital loss that goes along with owning this bond. Once again, it's perfectly fine to own a discount bond, a par bond, or a premium bond. The only reason I can assume that you might prefer a discount bond is if you didn't have $1,000. Right? If you didn't have $1,000, you might be able to afford a discount bond, but you sure can't afford a par bond or a premium bond. Questions? Okay. Let's go to the next one here. A bond, I didn't mean to have to tell you this, but face value is $1,000. The coupon rate is 6%, 10 years to maturity. The interest rate is paid semi-annually. How often does semi-annual happen? Twice per year, right. Twice per year. The market requires a 5% return on this bond. What is the market price of this bond? So let's go back to our calculator, and just so we can get back to used to plugging stuff in, I'm going to say clear second clear work. What do I put in for future value? 1,000. Future value. Now, what am I going to put in for PMT? 30. Why 30 and not 60?
60 divided by 2.
Yeah, 60 divided by 2. We're paying 2 payments a year. And then, N. What about N? What am I going to do for that? 20, because there are 20 semi-annual periods. 20. And then what am I going to do for I per Y? How much? Divide by 2. So what is 5 divided by 2? 2.5. 2.5 I per Y. And then what am I going to compute? Yeah, PV. Now notice that this price is very close to the other price. Did you guys see that? The other one was like 1,077.21. This is 1,077.95. Why is this bond worth more? Say again? Yeah, it pays twice a year. And what does that mean for compounding? Yeah, we're compounding more frequently, therefore the effective annual rate is higher. Does that make sense? And so, and the way you can think about this is that the first bonds that we looked at, you had to wait an entire year before you got any money. But with the semi-annual coupon bond, after 6 months, you receive half a year's worth of interest, and what could you do with that money? Reinvest it, right? And then you can start earning interest on that money. Does that make sense? Okay. So far, all we've been calculating is the price of the bond. But now we need to start looking at some of the other things. We got the bond with a face value of 1,000, coupon rate of 6%, 10 years to maturity, interest is paid semi-annually, and this time they tell us what the bond is selling for, and they ask us what is the yield to maturity for the bond. So let's get out our calculator here. We're going to say second clear work. I'm going to hit clear. And we know we can put in 1,000 for the face value. Whoop. And we're going to put in, what are we going to put in for PMT?
30.
30, very good. And then we're going to put in how much for years to maturity? 20. Actually, it's not years to maturity, right? It's semi-annual periods to maturity. And then, so we've got our coupon and our face value as positive. What are we going to do with this price? It's going to have to be negative. 864.1. Negative. And then what button do I hit? PV. And then I'm going to compute what? I over Y. Is this the yield and maturity for the bond? No. She says no. Why not?
Because that's for the semi-annual.
Yeah, semi-annual. And remember that YTM, yield to maturity, is an APR. How do I get from the semi-annual period to the yield to maturity? What do I do? Yeah, you got to multiply by 2. You got to multiply by 2. By the way, most common mistake that students make on these sort of problems is forgetting to multiply by 2 at the end. And by the way, Ms. Benias, do you think I could also have 4 on there as one of the choices? Yes, because I'm a bastard, right? Yes, it will be there. We call that a close distractor, right? So always remember, when you're doing semi-annual coupon bonds, when you're calculating the yield of maturity, it's twice the I per Y. Okay, now we've got a bond. By the way, I didn't tell you the face value. I'm freaking out here. What's the face value? It's got to be 1,000, right? A bond has a coupon rate of 6%. Interest is paid semi-annually. The bond yields 7%, and it's selling for $973.36. How many years until this bond matures? First thing I'm going to do is hit clear. Second, clear work. What's the first thing that you should put in? Because you always know what it is. What is it? Yeah, 1,000. Future value. What's PMT going to be on this thing? 30. And what are we going to do for present value?
Minus 973.
Yeah, minus 973.36. So 973.36, hit your plus minus button, and then we're going to hit PV. What are we going to put in for I per Y?
There's like 3.5.
3.5. It's 7 divided by 2, 3.5 I per Y. And now, what am I going to compute? Compute N. Does that mean it's 6 years? No, it's 6 semi-annual periods. So what do I have to do?
Times, I don't know, multiply.
Divide by, yeah, so 6 semi-annual periods would be, so there are 2 semi-annual periods in a year, right? And so if I take 6 semi-annual periods divided by 2 semi-annual periods per year, then that gives me 3 years. Okay, so I would just divide by 2, and that gives me the number of years. Questions? Okay, so here we have a bond. By the way, this bond is selling for 1,071.7. Is that a premium, par, or discount bond?
Yes.
Very good. It's a premium bond. And so we know, they tell us the yield to maturity is 5%. It's a premium bond. We know the yield to maturity. What can I tell you about the coupon rate of this bond? It's going to be higher than 5%. It's going to be higher than 5%. We'll see how high it is, but it's going to be higher than 5%, or it wouldn't be a premium bond. So get your calculator out. Clear second, clear TBN. It's selling for 1,071.70. I'm going to make that negative. Put that in as my present value. It has, okay, so it pays interest semi-annually. It's got 4 years left to maturity. What should I put in for N? 8. Very good. The bond yields 5%. What should I put in for I per Y? 2.5 I per Y. And it's asking what the coupon rate is. I think I've got everything in there. Did I put in 1,000 for future value? Oop, there we go, 1,000 for future value. Now, what am I going to compute? Payment. We cannot compute coupon rate directly. We have to compute the payment, and we have to work from there. Compute. Payment. I'm getting $34.99. Let's just say 35. So, 35. Would I just take 35, divide by 1,000, and say this is 3.5% coupon rate? No, why not?
I don't know, it just doesn't.
It doesn't feel right, does it? Okay, first of all, we know it can't be 3.5% because we said the coupon rate has to be higher than the yield to maturity. We know that. And so that should be something that tells you right off the bat, hey, wait a minute, this is not right. What do I have to do with this 3.5% number that I've just come up with? I got to multiply it by 2. I got to multiply it by 2 because there are 2 of these $35 payments every year. And remember that coupon rate times face value gives us the annual amount of coupon paid. And so what we're really looking at here is 70 divided by 1,000. We're looking at a 7% coupon bond. Does that make sense? Now, it turns out that we have these things called zero coupon bonds. I messed around with it here a little bit. They have no coupons, and so the entire amount of return that you get is based on net capital gain. So you're going to buy these things at a deep discount. Okay, now, here's the weird thing. You would think that we would price these based on annual, that we would treat them like they were an annual coupon bond, because after all, there's no coupons on the darn things. Weirdly, though, we price these as semi-annual coupon bonds. Let me say that again. Unless I tell you otherwise, a zero coupon bond is priced as a semi-annual coupon bond. In other words, this thing is paying 0 twice a year. You say, what's the difference between 0 once a year and 0 twice a year? It doesn't make any difference, except for the compounding, right? Because we're now looking at semi-annual periods instead of annual periods. We're compounding twice as often. Does that make sense? Okay, now, let's discuss why this is the case. And it comes back to history and tradition. If you go back to the old days, do you think bond traders, and even today, do you think bond traders have an MBA degree? No. Do you think they have an undergraduate degree? No. They might, back in the old days, they might not have even had a high school diploma. So here's how someone became a bond trader back in the old days. You started out in the mail room. You guys know about the mail room? We used to get mail, it was like actual paper, and you had to like take it to the person it was meant to be for. And so if you could do that job without screwing up, then they said, well, then you can be a runner on the floor of the exchange, or you could be a runner in the bond pit. And you would be physically running and taking pieces of paper to the correct bond trader to do the trades. And if the bond traders liked you and they took a shine to you, they might start teaching you a few things. And one of those things would be reading a crowd or reading the emotions of the market. And they would also start teaching you how to price bonds. But the overwhelming majority of the bonds that bond traders run into are semi-annual coupon bonds. And so when they set upon how they're supposed to price these things, they just decided, hey, let's keep it the same for zero coupon bonds. And so that's how we came to this situation where we do something totally ludicrous, like pricing zero coupon bonds as if they pay zero twice per year. Now, if I tell you a zero coupon bond pays interest, or is priced as an annual coupon bond, should you price it as a semi-annual? No. But if I don't tell you, the default is to price it as a semi-annual. It's just like the face value. If I don't tell you, the default value is how much, Ms. Black? Default value for face value, how much is it?
1,000.
Very good. Okay, questions? Next time, we are going to talk about what happens to a premium bond over its life and what happens to a discount bond over its life. I'll see you then.